Good morning, everybody. Hope you're having a great or had a great weekend, and you're got good January weather. We don't up here, so but we'll go ahead and get started. ECA has some things to cover. So Jerry and Don from Life have some great information for us today. So Jerry, can you get us started?
Yeah, absolutely. Thanks a lot, Mike. Great to be on with you guys again this morning. Don Teagues is going to be going over some life concepts with you today. I thought it would be a nice idea to get you up to speed on some of those things and some of those things that can be helpful to you guys in your practice. But before we dive into that, I did get in an email that I think most of you probably got, but I want to make sure that this message was across to you clearly. As American Equity is a carrier that we've used a lot, and I know how frustrating it can be when there's a training that's not completed or something like that. So this is one that I thought was kind of a little bit sneaky because it's outside of the ordinary of your normal product trainings that you have, and I don't want to see anybody forgetting this or missing it. So I thought it would be important enough to bring it up on a call. So what it is American Equity added in an additional suitability training to their module. So a lot of us, we get our product trainings when you guys come on board, or you have a lot of them done because you wrote those products. So automatically you just assume, hey, I got all my trainings done. So American Equity added a brand new one in. It's called Suitability, and it's added into the product training module. Everyone has to have this completed, or you'll have apps that end up getting turned around. You have to retake them. So kind of the rules on it is for brand new agents, it has to be done by February 3rd. And then for you current or active agents that have active American Equity contracts, you have until July 31st of 2020 to get it done. However, I wouldn't wait until then because you'll probably forget, because I don't know of any other carriers that have this additional suitability training a part of their product training module. You may see it with some others, so keep an eye out for it. So brand new agents, if you don't currently have an American Equity contract, and you go get it, it has to be done by February 3rd, or you can just imagine it's like any other training, have it done before you write. And then for current agents that have been writing American Equity and you have, you're current on all your product training, you have until the 31st. Again, don't wait until then to get it done. If you want to get it done, you can go ahead, email Ashley, and she'll go ahead. She'd be happy to get that link out to you to get that training done. So, make sure to get that done, and happy hunting when you're out there, and we'll have no problems when we're writing business. So, and then without further ado, I have, like I said, I have Don Teagues from the Life Department, who's going to be on today, and he's going to share a concept with you guys that I think is a good one that can add a lot of value to your practice, and I hope you guys enjoy. So, thanks a lot, and I'll hand it over to Don here.
Good morning. This is Don with ECA. Thank you so much, Jerry. Thanks, Mike, for having me on. I really appreciate it. And we are just going to jump right in. And my topic today is tax deferred to tax free. Now, I'm just wondering how many out there that you have clients that have any existing annuities that are there for wealth transfer, meaning that they're not going to put an income rider on them, or they're just there because they needed a vehicle for accumulation, and they're not actually going to use it. They just want to pass it on to their kids. Well, if some of these are called revenue neutral annuities, meaning that there's nothing you can do. You can't roll it into anything else because the current annuities may not be as good as the old annuities. But today we're going to discuss some options that you might be able to present to your clients. And again, it's tax deferred to tax free, and I like to call it tax deferred to tax free for LTC. So we're going to use the Pension Protection Act compliant annuities for this purpose. Now, consider this. We have a three-legged stool here. It's a well-balanced retirement strategy. The three most important aspects to consider is the lifetime income, wealth transfer, and long-term care. Now, we all do a great job at helping our clients balance their retirement strategy. However, some agents that I talk to really only get two of those three strategies taken care of. And you wonder why that might be. Well, the first two might be an easier discussion. The third, just because of, long-term care is kind of a bad term in the industry, or people don't like talking about it. But here's a really good concept that we're going to talk about that you will want to let your clients know about. All right. We go through life checking boxes, right? Well, consider this. 25% of a household will have a home fire. 26% of individuals will have be involved in an auto crash. 34% will have an unexpected medical expense. But look at that bottom one. 70% of individuals that are over age 65 will require some form of long-term care services. So you see, now than ever before is the perfect time for you to help your clients prepare for their long-term care needs. So why is it important to prepare? Well, look at this. Again, 70% of Americans turning 65 or older will need some form of long-term care in their lifetime. The number of people with Alzheimer's, and we all have stories, right? We all have stories of people who have had long-term care events who are suffering with Alzheimer's, but the number of people with Alzheimer's is expected to grow by 50% in the next 20 years. Now, we all know this too, that skilled nursing care is very expensive, and you have other options, but it's still, whether it's at home or a facility, it can be very expensive and actually jeopardize your client's retirement strategy. And this last bullet here, Americans spend nearly $70 billion, wow, out of pocket annually on long-term care expenses for themselves or even their family members. Now, look in your book of business. Do you have any clients that look like this? I mean, they have a realistic outlook. I mean, they're concerned about how they would pay for an unexpected healthcare event. Do they have the available resources? Do they have their rainy day fund intact? Do they have those annuities with you, or maybe even someone else, that are set aside for this specific purpose? And they have life experience. Their age, 55 to 80. We could even go as high as age 85 in some cases. But on this, in this discussion, we're going to actually just focus on those with non-qualified annuities. And under the Pension Protection Act of 2006, the benefits for qualifying long-term care can be paid out tax-free. Now, we all know that Americans have accumulated more than $1.6 trillion of assets in annuities. Most of these grow tax-deferred, until the funds are needed to actually help supplement their retirement income or their Social Security. However, the vast majority of these annuities are going to be left untapped and continue to grow until the annuity owner passes away. So now, if you're not sure, about what available resources your clients have, then just ask them this. If you or your spouse would ever need some form of care, which asset would you liquidate first? And, you just let them answer. And then ask, well, if there would be a better way to take care of that, would you be open to taking a look? So what is this Pension Protection Act that we were just talking about? Well, it was signed into law in 2006. And it was made to, the Pension Protection Act of 2006 made significant reforms to the U.S. pension law and its regulations. It was signed into law to protect retirement accounts and hold companies that underfunded existing pension accounts accountable. And part of that comes this portion with annuities and being able to transfer those annuities old annuities into a Pension Protection Act compliant annuity so that the funds can come out tax-free. Again, how does this work? 1035 into a PPA annuity, withdrawals come out tax-free, and as a reduction of the cost base, as you've seen there, means that the distributions from the policy are non-taxable and reduce the owner's cost basis in the contract, but not below zero. So we're going to also leverage the annuities for LTC. Consider the old way. An annuity with $200,000 of accumulation could hypothetically have a $100,000 cost basis. The old way would be just to take withdrawals from this annuity to pay for care. And everything over the cost basis, for the most part, would be taxed. Well, here's the new way. That same annuity is 1035'd into a PPA, or Pension Protection Act compliant annuity, and the client could receive double, triple, or even more of the benefit than the original 1035 exchange amount, all coming out tax-free. Now, here's a few examples of some cases that we've had some of our agents sell in the past. You look at Suzanne, she was 77. She had $200,000 that actually tripled the amount for her LTC benefit. Her monthly maximum was $8,333, and she had a 6-year benefit period. Joe, he was 64, had a $154,000 deposit, and that turned into $462,848 for long-term care. Now, with this particular annuity, they had a daily maximum benefit of $211 per day. And this also was a 6-year benefit period. Tracy, who was 65, took $168,000 of her money from an annuity, 1035, turned into a $743,000 long-term care benefit. And that was an 8-year benefit at $7,744 a month. And remember, all of this then, because of the way the Pension Protection Act is regulated, and all of this comes out tax-free. So which companies offer Pension Protection Act compliant annuities? Well, our biggest one is One America. They have probably the most options available, followed by Global Atlantic, and then Guaranteed Income Life. Now, we're going to talk a little bit about income riders with a doubler or a tripler. I get this question all the time. Well, why not just use an income annuity with a doubler or tripler on the income rider? And this is a great option for those who may not medically qualify for a long-term care annuity. Most annuities, the income needs to be turned on before the qualifying event. The income stream is then doubled or tripled only until the account value reaches 0. Then the income reverts back to the original amount prior to the long-term care claim. So, as we all know, clients are living longer, right? So when your clients need the money the most, that doubler or tripler may not be there. And regular annuities are not subject to the same rules and regulations as a long-term care qualified annuity would be, and the distributions are also not tax-free. All right, so that is the end of my presentation. We are here to help you. Yeah, just call the 5Q line. This is the ECA number that you see on your screen, but the 5Q line is 877-941-9710. Again, that's 877-941-9710. And feel free to reach out to anyone on the 5Q team, or feel free to reach out to the ECA's life team, whoever your life marketer might be, and ask them about the Pension Protection Act compliant annuities. Thank you so much.
Hey, Don, thanks a lot. Can you go back to that slide that showed the examples? So, guys, who would be good people? Thank you. Who would be good people to go back and talk to this about? Look at the differences here. How many people end up spending all of their annuity money before they go to the pearly gates? These are the people we work with. How many of them? Not many. Yeah, like 5% exactly, Till. So this is something that I would highly recommend. How many people are worried about long-term care? How many people are worried about long-term care? Yeah, most. And are they having to shell out, will this change moving 100,000, 200,000, 154,000, will that change their lifestyle at all? Shouldn't. So this is a concept that I would get in touch with your life marketer and put together a list of all of your clients and prospects and walk through the benefit. And remember, is this one of our, does this address one of our unique selling propositions, our elevator speech? Yeah, because the two things, that's right, Lonnie. The two things that we say are what? Have you been told about the program that will replace your spouse's income when they go to the pearly gates and they're no longer receiving their Social Security check? Have you looked at that program? Second thing is, have you looked at the program that will allow you to protect yourself? Now, with 600,462 or 743, we say we'll protect you for, we'll pay for your long-term care for 2 years without expensive annual premiums. Is 600,000, 462,000, or 743,000? Is that 2 years or a heck of a lot more than 2 years protection? Way more. Way more. Don, Bob asked, what is the best age? Is it, I think you said before, like 55 to 80? I mean, what's the sweet spot?
Well, each carrier has their own various sweet spots, but yeah, I would say obviously the younger the better, because as we all age, the lesser the benefit. But for sure, I would say 55 to 65, approaching 70.
And then what kind of medical conditions are a no-go?
Well, obviously, if they're already have Alzheimer's, that's a big one. If they're already confined or receiving some form of care, but for the most part, it's just the common, the big ones. I mean, if they have, I hate to say this, but HIV, if they or if they're already using a cane. Now this is weird. If you have a cane with one prong, you're okay. If you have a cane with 3 prongs on the end, you're declined.
Cool. So not only is it a life thing that they're looking at, it's also the activities of daily living they're looking at. So cane, already have Alzheimer's, dementia, those types of things. So is this something that's overly underwritten, or is it a typical life with a few, and they also need to be, not have any of those activities daily living?
Well, so yeah, I mean, this is an annuity. So
okay. So it's not that big.
It's not that big of a deal. Yeah, right. So if it were a life, yes, it's very simplified. If it were a life product,
cool,
then yes, there would be more underwriting. But typically, there's like just a few health questions, and that's it.
So a couple other questions, which I think are good. I think some people are still not clear. You can do this with a non-qualified annuity, correct?
Yeah, this is only for non-qualified annuities. The pension.
Oh, there you go.
Act, yes, only. Now, I get asked that a lot too. It's like, well, how can we get around, qualified annuities, the thing with tax? And unfortunately, Uncle Sam always will get their tax on a qualified annuity, qualified fund.
Yeah. So non-qualified. And then couple of other questions. Oh, one of them, and this I don't know anything about, but Till's asking, when is ECA rolling out the long-term care cell software for the folks that attended the week-long training? Do you know anything about that?
I will have to get back to you on that. So now I know that they rolled out the webinars that you can actually go back and take a look, but this software, I'll have to check into that and get back to you. So I do not know. I apologize.
Cool. No, that's a problem. And then we got a lot of other questions about health things. Will this or that or that or that work? So the best thing to do, guys, is to call your life marketer and find out what will work and what won't work. So obviously, all the life marketers are very familiar with this product and would do it. But I would, guys, this is one of the number one concerns people have. They don't want to be causing their lifestyle to change by having to spend $5,000, $6,000, $7,000 a year in premiums. So this is a fantastic thing to at least present. I mean, does it mean they have to do it? No, but should you be presenting this to everybody as an option, especially if they've got a non-qualified annuity, obviously. Coolio. Well, thank you very much, Don. And yeah, any other questions, guys, about what's suitable, who's not suitable, healthcare questions, those kind of things? Go ahead and contact your life person. Thanks a lot for covering this, Don. Appreciate it.
I appreciate you. Thank you so much.
Okay. And there you go, Mike. I went ahead and turned that back over to you.
Coolio. Thank you. So in last week's 1-minute snippet, we analyzed why mistakes can happen when we are meeting with clients. We all make mistakes, and as a lot of you have pointed out in the video, I made mistakes during that. When you're spending 2 hours talking to somebody, are you going to make mistakes? Yes, but when you make that mistake, you got to what? Know how to fix it. So that's what you could see how we could take a mistake and actually turn it into a rapport build. Oops, I'm not showing my screen yet, am I? I'll try that again.
Thank you.
Now I am. Should be. You see it?
Yep.
Yes. Okay.
Now we can see it perfect.
Okay. All right. So how we can turn a mistake into a rapport building event. So I addressed this last week, but I want to address it again. I know I've been Chicken Little for two years saying that the sky is going to fall, but I just and some people wanted me to review these slides from about a year ago, and that's what I'm going to do. So this was where they looked at, what if you moved the money too soon? What if you moved the money too soon before like in 1999? So you see, your crystal ball wasn't working well. You'd gotten out of the market in the end of 2007. You stayed in. You would have watched the $100,000 drop to $62,000. However, if you'd stayed the course, you watched your investment rebound due to 3 years of strong double-digit returns at $108,000 by 2012. If I didn't get those big returns since it had a 5% cap, but since it was still worth $100,000 even when the deficit crashed, if I finishes with $115,000. So here it's showing that if you got out 2 years early, so this gray one, orange one here, is the actual market, right? What if you'd gotten out in 2005 instead of 2008? 3 years early. 1, 2, 3 years early. Would you have been okay? Yeah, you've been more than okay, right? What if you got out 2 years early? Would you have been okay? What if you got out 1 year early? Would you have been okay? So this is showing you that getting out before the market crashes, don't try to get out. Should you try to get out the month before the market crashes, guys? What this is showing you is if you think the market is overvalued, you should do what? Get out now. Don't wait to time it. Okay? And this is showing back in 97. What if I got out in 97? This is look at, you're thinking, oh my God, I made a huge mistake here, right? 98, 99. I made a huge mistake here, didn't I? Because I didn't get in the market. Well, what happened? If you'd gotten out in 97, you would have been okay. If you'd gotten out in 99, you would have missed this much in the market and went down, came up, but you would have been what? Still better. If you gotten out a year early, boom, you still would have been better than the 88,000. So what this is saying is do not try to time the market. Get out when you think the market is overvalued. Buffett indicator. And again, this is do I ever show you the same indicator every single week? Saying, look at this one indicator. Look at this one indicator out of thousands. No, I'm showing you a different one every week. Here's another indicator. The Buffett indicator warned stock doomed for worst crash since 2008. The Buffett indicator flashed red right before the Great Recession hit in 2008 and the dot-com bubble. Did that? So is it a good indicator of major crashes? If it flashed both times, right before the Great Recession and right before the dot-com. Is that a pretty accurate indicator? Today it indicates the stock market is we're set for an even worse bubble. Before the dot-com crash, Warren Buffett predicted the stock market returns would fall dramatically in a rare 1999 speech. The U.S. stock market kicked off the new decade at record highs. There are plenty of good reasons for bull optimism. The cooling trade war, the sliding recession risks, rising employment, blue tech leadership, positive macro tailwinds. But for those wondering how much longer the bull market's going to last, the so-called Buffett indicator has a dreadful answer. Buffett indicator flashes red for stocks. Named after the widely venerated Oracle of Omaha, Buffett indicator reflects Warren Buffett's characteristically simple thinking about stock values. It's the total market capitalization of the United States relative to GDP. So here's what we had in, so does it look like it calls a lot of false? Is there a lot of false calls here? Because in 73, 74, was there a major stock market crash in 73, 74, guys? Please give me the right answer. Yes, major. 87 stock market. Was there a major stock market crash in 87? Yes. Was there one in 2000? Yes. Was there one in 2008? Yes. Was there a mini one here in 2016? Not a big one. I mean, we didn't go down that much. But now look at where we're at. We're higher than we've ever been before. And this, I think this is about as true an indicator of a market being overvalued as there is. Why? Because it's showing what? It's showing stock values compared to actual economic growth. So how much future growth has the stock market put into this? And again, this came from what? The major tax cuts here 2 years ago, and also all the stocks or all the companies buying back their stock. So this is, guys, this is just yet one more indicator that we've got problems, okay? So please pay attention to this and don't try to time the market. Get your clients into that 50-50 conservative, at least 50-50 conservative portfolio when you can. Okay, change is coming to the RIA industry. And how many of you know who Mark DeBergian is? I mean, he's a major thought leader when it comes to RIAs. So IRAs, here are the things that he sees happening in the coming years, in the near coming years, not in the next decade, but in the next few years. RIAs will get bigger, but there's going to be room for smaller IRAs too. Why will there be room for smaller RIAs? So the bigger are going to get bigger, and yet there's going to be more successful small RIAs too. Why? Why would there small RIAs be successful? Because they are much more what? Nimble and quick, flexible, right? Exactly right. Fees are going to do what? Go down. Fees are going to continue to go down, which means profit margins are going to go down. He predicts profit margins will halve in the next 5 years. As an RIA, he predicts that profit margins will be cut in half over the next 5 years. Now, he's thinking that a lot of RIAs, especially independent, smaller RIAs, they're going to go from outsourcing their financial management to using in-house with basically analytical services. Why do you think he thinks small RIAs are going to do that? Because it's what? If your profit margin, yeah, that's right, David, costs. It will be cheaper to do it this way than giving it to the big money managers. So he's thinking that there are going to be more people using ETFs and using analytical money management houses that are going to tell you how to invest your own clients' money, but you'll be able to do it cheaper. And obviously, he believes FINRA, the Securities and Exchange Commission, and the Department of Labor are going to do what with regulation? Is that gone? No. It's going to come back. It's going to come back. It's going to come back. There's going to be more regulation. And among that regulation, guess what he thinks is going to happen to variable annuities? He thinks they're going to be bye-bye. He thinks they're going to be hammered, especially any variable annuities inside qualified accounts. And the financial planning designation is going to be highly regulated. So insurance-only people calling themselves financial planners are probably not going to be able to do that in the very near future. And basically he's saying that he feels, just like what happened in England, that what's going to happen to money management fees based on money management, on the amount of money you have. You feel that's going to go away, and they're going to go to a flat or hourly fee. So And what did that do to the the UK's financial advisory, being a financial advisor as a job? What happened to yeah, they lost almost half of their people in the first 3 years. Almost half of the people who are financial advisors were gone in the first 3 years. The UK changed those laws. So why do you think I'm showing you this? So those of you that are sitting on your high knees thinking, well, I'm building a house this year, so I'm gonna take 6 months off, or I'm getting a divorce, so I'm gonna take 6 months off and lick my wounds, or I'm doing this or doing that, guys. If you want to make money, if you want to set yourself up for retirement, when should you be doing it? when should you be doing it? Is it going to get better? Is regulation going to be more lenient or less lenient? Are we going to see fees higher or lower? Are we going to be seeing money management fees and commissions go away and go to an hourly fee sooner rather than later? So guys, be thinking, I got to make hay while the sun shines. I got to be out there. I need to make all the money I can in the next 3 years, not in the, if I don't have a bad year, I've always got next year. If I have a bad year, I have next year. No. If you're thinking that way, you're going to have problems. You need to make enough money in the next 3-4 years that you can retire. Does that make sense? So that's my little, does anybody disagree with any of these things DeBergen said? I'm getting a lot of yeses with all of those things. So make hay while there's hay to be made. Don't spread your marketing dollars over the next 3 years. Spend it all this year so you can spend another 3 years worth of it next year and the next another 3 years for the next year, so you can make as much money as you want now while the environment is as friendly as we're ever going to see. It's not as friendly as it ever has been, because it was a lot more friendly. Anybody been in the industry long enough where they saw that back when you could get mutual funds paid 10% commission? How many 10% commission mutual funds are there now? It's only going to get worse. So what you see right now is as good as it's going to get. It will not get better. It will only get worse. So dive in. Make your plans for 2020. Make your plans for 2021. Make your plans for 2022, because now is the time to be creating such a successful business that you can ride it through the rough times that will be coming in the next 2 or 3 years. Make sense? Awesome. You guys have a great rest of the week, and we'll talk to you all next Monday. Thanks, everybody.